Hello, mates of Equity Mates. Or I guess that just makes you equity mates. Anyway, it's Bryce here. One of the most frequently asked questions we get is, where do we find information about all these stocks and where's a good place to start? Now, we could do a whole episode on this, and we often do touch on it, but the best place to start is by signing up to our Thought Starters weekly email. Each week, we send you some cool stuff that has caught our eye during the week, as well as some more detailed articles on stocks and invested-relating content. We also include Basics 101. These are articles tailored specifically for beginners to really propel you on your way. We don't spam you. We hate spam. It's once a week and there's enough stuff in there to occupy you for a full day of browsing at work. Now, Ren puts a lot of effort into finding quality articles for you guys, so if anything, just sign up so he feels the love. Head to equitymates.com and chuck in your email at the bottom of the page.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, where we will help you learn to invest in 15 minutes or less. We break down the world of investing from beginning to dividend so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. How are you?
Can't complain. Back in Australia.
Yeah, great to have you back.
Thanks, mate. 2 weeks in NYC, New York, and a couple of days in New Orleans. So that was a nice break.
Yeah.
You held down the fort while I was away. Good to see. We haven't crashed and burnt.
No, we haven't. Hopefully the listeners didn't even realise, episodes still came out on time. Thought Starters still went out.
Yes. Good to see.
Although we should say, for our last episodes, our last two episodes, the Andrew Brown interview, we apologise for the quality of the audio. We know it wasn't great, but the quality of the content we thought was good enough to keep it in, even with the poor audio, and we hope you guys feel the same way. We're going to look at our live interview setup, and hopefully the audio quality won't be that poor again. Yes.
This show is all about the journey, and we are on the journey of this whole podcast thing ourselves. Yeah. So we've taken some learnings from it, and we'll make sure that next time that doesn't happen, because, as you said, Ren, the content in that was great. So hopefully people can get through it. Yeah, and if you did give up on it because of the audio, I would definitely recommend giving it another crack. Some of the things. Every time we speak to Andrew, I feel I leave a smarter and better investor. And I think some of the really practical advice that he has, and some of the, he talks us through his day at E72, how he analyzes a stock, how he keeps on top of information flow. So there's some really practical information and advice in there that I think anyone could use. Absolutely. Yeah, I would agree with that. Yeah, to the point that we always walk away and say, should we be investing with Andrew Brown? Yeah, so, yeah. He knows what he's talking about, that's for sure. He definitely does, yeah. But anyway, enough looking backwards. Well, actually, yes. A little bit more looking backwards. How was your trip? Trip was epic. Yeah. Pretty loose, as you would expect, I think. We went over with a couple of mates and met one of our mates, Elton from uni. So met him over there. He lives in New York now. So we're over there with total of 4 of us, and we did some pretty cool things. We went to the Book of Mormon on Broadway. We went to a baseball game, saw the New York Yankees versus Washington Nationals. We went to the Comedy Cellar, saw some pretty funny comedians. We went down to New Orleans and saw some jazz music and the infamous Bourbon Street, and had a really good time. So the weather was great. The big question is, though, did you go to the other infamous street, Wall Street? Certainly did, yeah. Went down to the financial district down there, saw the Charging Bull and the little girl as well, and we went down, walked on Wall Street, Broad Street, saw the New York Stock Exchange, hung around there, threw a few trades down. Yeah, nice. We actually tried to, get in, but it's impossible to get in these days. The security is ridiculous. Yeah. One thing, we were sort of sitting there, we decided to just perk up and sit there and watch it all unfold. It was around lunchtime, so there was a lot happening. And, the New York Stock Exchange building is quite impressive to look at it itself. But we were thinking to work there, like you've got to go through what looks like so many security checkpoints and also battle the thousands of people that are tourists like out the front taking photos and all this sort of stuff. Like it'd be a nightmare to get in and out each day. So that was an interesting part. But yeah, we went down to Financial District. It's also close to the 9/11 Memorial, so knocked it all out. Statue of Liberty as well, so it was nice down there. So I actually did a bit of a recording down there while I was sort of sitting there, and it's a bit of a history on the New York Stock Exchange. And also opposite the New York Stock Exchange, there's a building called JP Morgan House. For those that aren't aware, JP Morgan is one of the biggest investing banks in the world. And so it's got a history behind it. Obviously, JP Morgan was a man at some point. And so I did a bit of a history on that as well. So we'll...
All right. Well, don't give anything... Yeah, don't give anything away. That Bryce's tour of Wall Street and the Financial District will be released. This episode's out Tuesday. Let's say on next Sunday. So
we'll
Sunday the 24th.
Yeah.
Everyone, mark it in your diary. Set a reminder in your phone. Bryce's tour and history of Wall Street will be in your podcast feeds then.
Yeah, that sounds good. All right, bro. Well, let's get stuck in. So today we are going to do a basics 101 and look at protecting the downside, protecting your portfolio when things turn south, and what it means and what ways you can protect. What ways are available for you to be able to protect your portfolio, and also what are some of the risks involved in doing so. So, do you want to kick it off, Ren?
Yeah, definitely. So let's start with what it is. So obviously everyone knows that the market or the price of any asset can sometimes crash. And for a lot of people, it's that fear of the catastrophic event or, just picking the wrong stock and it falling 20%, 30%. That fear keeps people out of the markets. It shouldn't, because over the long term, markets trend upwards, and it, being in equity markets, being in the share market, has been the biggest creator of wealth in the last, century, or couple of centuries. So, what this episode is about how you can be in the market, how you can access that wealth generation that equity markets create, while protecting yourself as much as you can from that risk, from losing it all in the GFC, or from picking the wrong stock and seeing it crash, or any other sort of catastrophic event.
I would like to add there that it doesn't necessarily also have to be a catastrophic event that you're protecting yourself from. Like, you could be just looking at an individual stock level as well, and you might say that you're willing to lose 20%, say, or 10% on a stock that you purchased, and that might come about from, it doesn't have to necessarily come from a total market collapse or anything like that. You could be protecting at an individual level as well. So this episode's all about protecting your capital, which is essentially the main function of any major fund manager at the end of the day, is to manage risk and protect their investors' capital. So
yeah, definitely. I think Warren Buffett, rule number 1 is don't lose money.
Yeah. Rule number 2 is rule number 1, isn't it?
Yeah, I think so. Isn't that also Fight Club?
Something like that, yeah. Who said it first, I wonder?
Yeah, I don't know. Buffett is a big Brad Pitt fan, I hear, so...
Actually?
No, I don't know. I mean, probably.
Surprising, he's a weird man.
I don't know. Mate, nothing wrong with being a Brad Pitt fan.
No, when would it... Yeah, I don't know. I can't see him sitting down watching Fight Club. Anyway.
Yeah, no, I could see it. But maybe back in his younger days.
Yeah.
Although the amount he reads, apparently he reads 500 pages a day. He probably isn't catching too many movies.
They could be scripts to Fight Club. Who knows?
They could be. All right. So anyway, back to protecting your downside. So that's the sort of what and the why. You want to protect yourself from risk as much as possible. Now let's talk about the how, I guess.
Okay, so I'll start, and then so this is two ways that you can do it, and this is involved in when you put in the trade. So it's done through your brokerage platform, and it's essentially putting in a stop loss, or otherwise known as a falling sell, or you can do another thing called a trailing sell. And so these are both sort of techniques that you can use to limit the percentage or dollar loss on a stock if it's falling or if it has risen and then falls again. So let's start with a falling sell or a stop loss. And this is a technique that many traders use, but some long-term value investors don't really believe in a falling sell, just because in their eyes, if a stock is falling and you are prepared to buy it at, say, $2 and it falls to $1.50, then in their eyes, it's probably a more attractive option to buy at $1.50 rather than sell and protect your losses. Would you agree with that, Ren?
Yeah, I would. Let's just start with what they are.
Okay. So a falling sell essentially helps you lock in or protects the amount of losses that you are going to make. So, for example, let's say you buy 1,000 shares in Equity Mates at $10 a unit, and you're prepared to lose, say, 10%, then you've bought it at $10, and that means you're wanting to sell out if it falls down to $9. And so you would put in a trigger price or a stop loss of $9. And then if the price falls to that trigger point, if the market is there, then they'll sell the stocks at that amount and limit the amount that it falls further. So I guess that's the top line basic idea of a stop loss. Essentially, it's all in the name. You're stopping any major losses. I think one thing to point out, though, is that if the price does fall too quickly, sometimes it can fall below the trigger price too fast and it won't sell out if the market's not there to sell it out. But more often than not, that doesn't necessarily happen. So do you have anything to add to a stop loss, Ren?
No, I think you've described it pretty well. So that the stop loss is where you nominate a price where it will automatically sell if it falls below that price.
Yeah.
And then the second one that you touched on was a trailing sell. So what's the difference between a stop loss and a trailing sell?
So a trailing sell is where it protects your upside and it protects the profit. So it's not necessarily when your stocks are falling. This is something if your stocks are going up and up and up and you want to take those profits in case the stocks then turns. So say, for example, let's stick with Equity Mates Limited. You've bought 1,000 shares in Equity Mates Limited at $10 and it starts rising and rising and rising. You can then tell your brokerage or the system that you want to sell if that share price sort of falls 5% from its peak. So say if it goes from $10 to $11 and then it turns and starts to fall, it will sell at that 5% below $11. So that protects the profit that you've made between $10 and $11. I hope that makes sense.
Yeah, I think it does. So very simply, a stop loss is when you buy it, you nominate a price where if it falls below that price, it will automatically sell. A trailing sell is where you say if the stock falls, X percent, then sell it. So if it keeps rising, then you're fine. And if it's risen heaps, a stop loss wouldn't be appropriate because you'd have to keep automatically adjusting it up as the price also rises up. So this trailing sell just automatically follows the price going up, and then will lock in your profits by selling when it falls off a bit from its top. Say, you were saying 5%, but you could set it to whatever percentage you want.
Yes.
Yeah.
So two relatively straightforward techniques that you can use to prevent losing out too much on either profits or on losses. They're definitely techniques that require a bit of thought, and the more advanced traders and investors use. As I said, some investors are hell-bent on always putting a stop loss in regardless of whether or not they're a long-term investor or a trader. Others don't see any value in them whatsoever. So it's completely up to you on how you use them. Personally, I don't have stop losses on everything. I've got stop losses on a few. I don't know about you, Ren, how you approach this.
I with our brokerage, well, with the brokerage platform that I use, IG, I don't think I can set stop losses.
Interesting.
Well, either I don't know how to through IG or I can't through IG. If anyone knows how to with IG, reach out to us.
Well, look, I've just had a quick Google on and had a look at IG, and they have a section on setting stop losses. So I'm not sure if that's an education piece or if it's them showing us how they can do it through their site. But anyway, we'll figure it out.
I'll have to Google that after this episode, and I'm sure there's a way I can do it. Yeah.
Yeah.
But anyway, so what we've just covered off there with a stop loss and a trailing sell are two ways to protect your downside on individual trades.
Yeah.
So you set a stop loss on the share or the ETF that you've bought. Same with the trailing sell. So they're the good ways to protect that individual trade. But there are also ways that you can protect your downside when you consider your portfolio as a whole.
Yeah.
And so there are three main ones that I'll list, and then we can go through them one by one. So the first one is shorting, or buying shorting equivalents.
Yeah.
The second is buying counter-cyclical assets, and we'll explain what that is in a sec. And then the third is just holding cash.
Yeah.
So the first one is shorting, and shorting is where you either use options, which you don't need to worry about too much, or you sell shares into the market with a promise to buy them later. But what you can also do is there are ETFs out there that are inversely correlated to the market. So that means every percentage the market goes down, your ETF goes up, that percentage. So you make money as the market falls. So if you want to protect your downside, you think that the markets are getting closer to a top, you can get an inverse ETF, and it will provide you some downside protection.
Yeah. So a good example of this is bear, which I'm pretty sure we've discussed at some point in this show many times. And we even have it in our hypothetical portfolio that we did way back at the start of last year. And it is not leveraged, which we can discuss in a minute. And it's inversely correlated to the Australian equities. So, when the Australian equities goes up, bear goes down in price, and when the Australian equities goes down, bear goes up in price. And so a strategy that you can use with these, Ren, is obviously you don't want to be 100% in these because it's not the best way, but a lot of people use these as a percentage of their portfolio just to make sure that if the market does turn, then they're not going to be seeing red across their whole portfolio, and they'll at least be making some sort of gain in these stocks should the market turn.
Yeah, definitely. Now, the second one is counter-cyclical assets.
Yep.
So markets move in cycles. They go up, they reach a top, they go down, they reach a bottom, they go up again. And there are some asset classes that traditionally have moved against that normal equity market cycle. So when equity markets are going up, these assets are going down, and vice versa. So similar to inverse ETFs, people put them as part of their portfolio to give them some protection if the market falls. And then what they can also do is then sell them and buy really cheap equities when the market's at the bottom. So the traditional counter-cyclical asset has been gold, and also silver to a lesser extent. That gold is going through a bit of a funny period at the moment, but we can do a whole separate episode on that.
Yeah.
Another big counter-cyclical asset that people have theorized, but it hasn't been tested yet, is crypto and Bitcoin in particular. Yeah. But look, I wouldn't want to be the guinea pig on that one.
No.
I think you'd want
especially with Bitcoin's price movements lately. Jeez.
I think you'd want to see a few market cycles before you were confident it was a counter-cyclical asset.
Yeah.
And not just some crazy asset doing its own thing.
Yeah. So just very briefly, a couple of ways that you can get access to these commodities is through ETFs. You can buy ETFs that follow the price movement of gold or silver. And then there's a number of other financial products that can give you access to gold and silver. But I would think that the easiest way is probably through an ETF for a beginner, Ren. Would you agree?
Yeah, definitely. That's how I've accessed gold.
Yep.
I mean, look, if you If you want to buy gold itself, get some gold bullion, then I wouldn't hold it against you.
Buy a pickaxe and head out to Ballarat.
Yeah. People buy gold coins and stuff like that. But yeah, definitely the easiest way is just a gold ETF.
Yeah. And again, this is a strategy that you can buy the ETF and just sit it there as a small percentage of your portfolio. Don't expect too much from it, but it's just there to know that if the market starts turning, then you're going to have something there that hopefully, if trends continue the way they have historically, you'll have something that makes you a bit of cash. So what's the third one?
So the third one, speaking of making a bit of cash, is holding cash. So the best way to protect yourself against risk is to have your wealth in cash, but it's also the worst way to make any money. So it's a balancing act.
So this is me right now.
What? Everything in cash?
Holding cash.
Yeah. But
eating away at me.
The way to think about your cash to investments balance, I guess, is as markets get higher and higher, and you've made more and more money from your investments, start taking some of those profits, and then when the market inevitably starts going down the other way, as markets always do, then that cash that you have, you can start putting it back into the market at low prices and let that cycle repeat. So you obviously, as you're taking money out of these investments, you might be cutting your winners short and you might be taking money off the table, but in terms of protecting yourself against risk and setting yourself up for the next big opportunity, just slowly taking some cash back out as the markets go up is always a good idea.
Absolutely agree, yeah. Don't be greedy and leave it all in there.
Yeah. But don't be stupid and take it all out as well.
True.
It's a balancing act.
True.
All right, so that brings us to the end of this Downside Protection Basics 101 episode.
Yes.
We've discussed a couple of ways that you can protect individual trades or individual investments. So that's a stop loss and a trailing sell. And then there are other ways that you can protect your downside as a whole in your whole portfolio. And some of the ones we discussed were inverse ETFs or ETFs that short the market, counter-cyclical assets like gold and potentially crypto, but potentially not crypto as well.
Yeah, we don't know.
Yeah, strike crypto. And then the third one was holding cash. So cash is obviously the safest way to ensure you don't lose any money in your investments, but it's also the safest way to ensure you don't make any money on investments. So it's a balancing act, but as the markets get higher and higher, as you were saying, you've gone to cash. It's definitely something a lot of people should consider.
Yeah, absolutely. But man, it's tough staying. It's tough sitting here. I tell you what.
Yeah, and we should say you would never go to 100% cash.
No. That's a silly thing to do.
You would go from having no cash to having 5% cash to 20%, 30%.
Yes.
I'm just pulling numbers out here, but we talk about being a long-term investor and investing through the cycles and holding in the bad times and the good times and letting it grow over a long period of time. And that's probably one that we didn't talk about. The most important way to protect your downside is just not panic when something bad happens and just really hold for the long term.
Yeah. Don't freak out and sell.
Yeah.
Yeah.
All right.
No, good one, Ren.
Well,
all right.
It's great to have you back in the country.
Yeah.
Back in action.
Back in odds. Feeling fresh.
Yeah.
Ready to go.
I hope going to Wall Street has inspired you for some Equity Mates content.
Yeah, well, I got a job. I'm out of here.
Yeah,
nice. I'm
nice.
quitting Equity Mates. Bye.
All right, that's our final episode of Equity Mates.
Yeah, no, it was good. I'm looking forward to giving you a few cool little tidbits on Wall Street. So I'll get that together and we'll release it at some point in the coming weeks.
Well, we told everyone at the start of this episode, Sunday the 24th. They've already marked it in their calendars, so that's the date we're working towards.
Okay. Sounds good, bro. All right. Well, good to chat to you finally again. Bring on the second half of 2018. First half was pretty exciting for us, so hopefully we can double down and make it even better. So
Yeah.
let's do it.
All right.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.